back. We now go to the gentleman from California, Mr. Sherman, who is recognized for 5 minutes. Mr. Sherman? Would you like us to move on?
If it's Josh's turn, it's Josh's turn.
Gentleman from New Jersey is recognized for.
Thank you, Mr. Sherman. Thank you, Mr. Chairman. Chairman Powell, you have said that custody assets are off balance sheet, always have been, and do you stand by that?
Sorry, say that again?
You've said that, quote, custody assets are off balance sheet, always have been. Do you stand by that statement, sir?
I think as a general matter, yes.
The SEC's Staff Accounting Bulletin 121 affects a core banking activity, custody. The specific bulletin requires banks to put digital assets held in custody on their balance sheet, effectively keeping banks out of the market entirely. Have the Fed and the SEC had conversations about the impact of SAB 121, and just wanted to get a sense of your thoughts on the policy, please?
So as you know, I think we don't comment on the SEC's policy. They don't comment on our policies either. So I know that I knew you were going to SAB 121 on that, but honestly, it's the SEC's business, not ours.
Thank you. Last month, you said that when evaluating inflation data, you consider whether wage growth is outpacing productivity. From 1979 to 2019, middle-class workers' productivity grew about 60%, while their wages grew by about 16%. Do you consider this historical gap when considering whether to hike rates on families obviously struggling to make ends meet?
So we're looking at inflation, and we're looking at maximum employment. Those are our goals. We don't really have the ability we don't have a bunch of different tools for things like what you're talking about. So really, it's just those things. Of course, we're very well aware of longer run trends like that. You have to also include benefits, though, in that analysis, which does close that gap quite a bit. You just mentioned wages.
I appreciate that. Thank you. Mr. Chairman, yesterday the Director of National Intelligence said that, quote, Iranian government actors have sought to opportunistically take advantage of ongoing protests regarding the war in Gaza, end quote. They have observed actors, quote, observed actors tied to Iran's government posing as activists online, seeking to encourage protests and even providing financial support to protesters, end quote. As a member of the House Select Committee on Intelligence, I'm equally concerned about our adversaries meddling in our financial system. Can I have your commitment, or if you can discuss if you're working with other federal agencies to investigate and address foreign interference channeled through our financial institutions?
So we do take part in many of those things, especially at the staff level. And as you know, there's a lot of focus in the intelligence community, and it's very helpful to the banks, the commercial banks, and to us. But we're certainly very focused on those issues. We've got a strong team. Of course, you're never able to sleep on cyber risk, but we just keep fighting it.
I would like to switch gears to the discount window, please. Chairman, we've heard that the discount window is behind the times in terms of its operations. We also continue to hear that efforts to modernize the discount window and encourage its use will be ineffective without reducing the associated stigma. The usability of the discount window is an important tool for banks that need liquidity. Just wanted to get a sense of efforts underway to make the discount window a more realistic option for banks that need liquidity.
So it's a couple of things. First, it is we need to modernize our infrastructure. The discount window in our system is not a primary source of credit. It's a source for banks that they can use under certain circumstances. So, but we know that the infrastructure is a little tired, and we're investing in that and making it more user-friendly and all that. So that's a big project that's going on. Sorry, the second point was stigma. So stigma is that's tough. That's a tough one, and it amounts to there are a lot of ways to get after that. We're studying all of them. In a sense, if you require banks to use the discount window, then that can help with the stigma. This is a big ask, but when Congress required us to publish the names of discount window users, that didn't help. It doesn't help at all, because banks basically say we're not going to use discount window because it might, people might see us as troubled, And that's not what we want. We want people to be able to freely use the discount window. So we've been focused on this issue for a long time, have not made a lot of progress on it, but right now I think we're very focused on it.
Thank you, sir. I'll yield back. Thank you.
Gentleman yields back. We now go to the gentleman from New York, Mr. Lawler, who is recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, to the best of my knowledge, the last public meeting between you and President Biden occurred on May 31st, 2022. Does that sound accurate?
I'm going to take your word for it.
Okay. Have you had any private meetings with the president since that time?
No,
Any phone calls with the president?
I don't believe so.
Is there any reason why you've not met with or spoken to the president?
I mean, I meet with, when any president calls, you come and you meet, but that hasn't happened, so.
So in over 2 years, with inflation still nagging us, with cost out of control, President Biden has not asked to meet with you in over 2 years?
I haven't had a meeting with him. He hasn't sought a meeting, and of course, I don't seek meetings, so you have the date. I don't.
But to your knowledge, in the last 2 years, you've not spoken with or met with the president at all?
He shook his hand in a line once, but that wasn't a conversation. It was just, Mr. President, and that was it. It was at a state dinner. I attended a state dinner a few months ago, and I shook his hand. Good evening, Mr. President, and that was it.
Does that not strike you as odd that the president has not sought to meet with you?
Not at all. Not at all. We're an
Mr.
independent
Chairman.
agency, and
Mr. Chairman,
seeks
parliamentary inquiry, please, Mr. Chairman.
I'm
Am I
sorry.
recognized?
I want to answer your.
State your inquiry.
Thank you, Mr. Chairman. I make a point of order under Clause 4 of Rule 17 that the gentleman's words are disorderly and violate the rules of decorum in debate insofar as they are negatively reflecting upon the personality of a candidate for President of the United States.
The congressman is not engaged in any personality or in any, has questioned anything about anyone at this point. I'm not sure where you're going, Congressman. Congressman is recognized.
Thank you.
Mr.
Thank
Chairman.
you.
Happy to answer your
Chairman.
question.
Mr.
Can I
Chairman.
answer your question?
Thank you.
Mr. Chairman, I'd like to
Not at all
continue with the
unusual.
point of order, please.
What is your point of order?
Mr. Chairman, we have been admonished in this committee that we should not have words that negatively reflect upon persons who are running for president. This would include Mr. Trump as well as the current president.
Didn't the ranking member do a whole opening monologue
Chairman,
diatribe about some ridiculous
Would you please
Project
rule my friend
2025?
out of order, Mr. Chairman, until you rule?
Mr. Lawler
he's
has
already
not
ruled.
admonished or said anything negative about the president at all. I just listened to his comments, so I'm going to recognize the congressman again, Mr. Lawler from New York.
Thank you, Mr. Chairman. Mr. Powell, you were trying to answer my question.
So we're an independent agency. The administration has been very respectful of the Fed and not, wanting to try to influence and things like that. And I don't find it at all unusual.
Independent agency. Independent agency. Pay attention to the language.
That's totally fine.
Since you made mention of the independence of the Fed, and I know you pride yourself in that independence, do you acknowledge, or do members of the FOMC acknowledge, that a rate cut in September could be viewed as political just 30 to 60 days before an election?
So our undertaking is to make decisions when and as they need to be made based on the data, the incoming data, the evolving outlook, and the balance of risks, and not in consideration of other factors, and that would include political factors. We will make those decisions. We have a long history of doing that, including during election years, and that is the undertaking we'll make. Anything we do will be very well grounded, and it's just not appropriate for us to get into the business of thinking about election cycles at all, one way or the other.
So inflation year over year from May 2024 to from May 2023 to May 2024 is up 3.3%. Overall inflation. Energy inflation is up 3.7%. Food inflation up 2.1%. With inflation continuing to be a challenge, do you see a rate cut as a possibility at this moment?
So I think you're quoting the CPI numbers, which are operating at an unusually high gap to the PCE. For 25 years, the Fed has focused on personal consumption expenditures inflation, PCE inflation. And usually the gap to CPI is only 25 or 30 basis points. It's more now. So the PCE numbers, the current PCE numbers are 2.6% for headline, 2.6% for core. And we've articulated for a good long period our test for being willing to consider beginning to loosen policy. And that test is that we want to be more confident that inflation is moving on a path sustainably down to 2%. Not at 2%, but on a path sustainably to 2%. That's the test we've articulated. I have some confidence, as I said earlier, that we are on a downward path. I think if you look at the data, it's pretty clear that, but we have not said, though, that we have sufficient confidence, and that will be a decision that our committee makes.
Yeah, I would just note, obviously, CPI, the price of goods, the price of purchasing a home, the price of a mortgage, the cost of a mortgage has been astronomical. In Westchester County, for instance, where I represent, the average mortgage cost is up $1,000 a month, over $12,000 a year. In the time I have remaining, quick question. In your meetings with the president, have you noticed any mental or cognitive decline?
No.
Thank you. I yield back.
Point of order.
Gentleman's time has expired. Gentleman from
Point of order,
Texas.
Mr. Chairman.
Point of order.
Yes, Mr. Chairman. The gentleman just mentioned the president's cognitive capacity, and I believe this to be a violation of the rules with relationship to decorum, and that this goes into a personality of a president.
Gentleman's time had expired. You're recognized now for your 5 minutes, Mr. Green.
My point of order is to be made immediately after the gentleman's statement, and that's what I'm doing.
I would remind members not to engage in personalities and comments about the president.
But, Mr. Chairman, if I may, with my point of order, I demand that the gentleman's words be taken down insofar as they negatively reflect upon a candidate for President of the United States.
Gentleman from New York, Mr. Lawler, is recognized.
I'll happily withdraw my words, though everybody understood them.
Mr. Chairman,
Gentleman withdraws his comments.
I find
Mr. Green, you're
his
recognized.
final, if I may, Mr. Chairman, his final comment was, although everybody understood them, in my opinion, that then brings us right back to where we were before he made his attempt to withdraw. Now, if he's willing to withdraw appropriately, I will not demand. But until he does so, I demand that his words be taken down.
The gentleman's time had expired.
Mr. Chairman, the time does not expire on the request that I've made, the point of order. The time didn't expire on that.
I recognize
Let
Mr. Lawler.
the record reflect I withdraw my words.
Thank you, Mr. Chairman.
Gentleman from Texas, Mr. Green, is now recognized for his 5 minutes.
Thank you, Mr. Chairman, and I thank the chair for appearing today. I hope things are going well with you. I know that this is a difficult time for you, and quite frankly, you've been in a difficult time for a number of years, and you've proved to be quite resilient and quite effective at what you do, so I thank you for what you're doing. I do want to ask you about several things, and I hope that I'll get to them. But first, there was a post-failure lessons report after the failure of Silicon Valley and Signature Banks. I thought that report was pretty important. How important is that post-failure lessons report?
It's important. We wanted to learn the right lessons and make the right changes to both our rules, but also really to our supervisory practices more than anything else, and we're doing that.
And is this something that you believe to be important after each incident, such as what happened with Silicon and the other bank?
Yes, I think, I think we all have a lot to be humble about, and we try to learn from events.
Thank you. Let me go on to the next question, which has to do with the banks that are small. Let's talk about those that are less than $5 billion in total assets, yet they are subject to the special assessments of the FDIC once there is a systemic risk exception triggered. I'd like to see them exempt from that. Do you have any comments on it?
That's really, that's either a statutory matter or it's a matter of the FDIC's practice. So it's not something the Fed has any input into, really.
Okay. Let's do this next, please, as time runs out. Would you kindly finish your commentary? You were giving a comment on the pandemic and how the pandemic helped to generate this inflation, and you were stopped in the middle of your comment. So would you go back through that, please, so that the public at large can get a better understanding of what actually happened with the pandemic and inflation?
So I'd be glad to. And I think people are now, we have a few years to look back. I think the more years that pass, the clearer we can see what was happening. But I think you look back now and you're seeing this, broadly what was happening was governments did a lot to support economic activity during the pandemic, and on the theory that, there could be really serious economic bad times ahead. Then the economy reopened, and it reopened very, very strongly. And I think in hindsight, you can see that there was just a lot of support for demand from fiscal policy, from monetary policy, and that supply was constrained. You couldn't make cars. Supply chains were tangled up. There were shortages of so many things. So what happened was we got a burst of inflation, and the United States got a big burst of inflation, really, more from demand than other countries did. Then you have the war in Ukraine, which gave a big burst of inflation more to Europe than to us. And so you wind up with a situation where you've just got a lot of inflation, and my thinking at the time was it's going to take restrictive monetary policy, and it's going to take time for the supply side and demand side distortions from the pandemic to unwind. 2023 was the year when that kind of happened. So supply chains were fixed, the labor shortage was greatly alleviated, and unemployment remained very low. Inflation came down by a very large amount last year, while growth remained quite strong. So this was the year that kind of proved that thesis. Now we're in 2024, and it's a question of finishing the job on inflation, which we're committed to do, while also keeping a strong labor market, which we're also committed to doing. And that's a balance that we have to strike in our policy. But I think we know more now about where this came from, because we can see what made it go away. And it was a combination of supply and demand, as we had kind of expected.
And two of the most significant factor, correct?
Yes, and it's also the fact that the pandemic summoned forth a great fiscal and monetary response, and that contributed to really strong activity and to inflation, without question.
We're going to run out of time, but I have to ask, if not for that monetary response, I know that it's a counterfactual, but would we have possibly gone into a depression?
That's what we thought at the time, and I think mainstream economists were very concerned that, we'd never literally shut the global economy down for a period and then tried to reopen it. We didn't know how long it would take or how well that would go.
Thank you, Mr. Chairman.
Gentleman's time has expired. We now go to the gentleman from Oklahoma, Mr. Lucas, who's recognized for 5 minutes.
Thank you, Mr. Chairman. And thank you, Chairman Powell, for testifying today. I realize that my questioning point in the hearing today, probably a lot of material has been covered, but there's nothing ever wrong with asking important questions a second or third time. You've reiterated how members of the board would like to see a revised Boswell proposal put out for public comment, and you're working through the process with FDIC and OCC. From my perspective, the FDIC is in a period of uncertainty. The current chairman announcing he'll resign to restore confidence in his agency, and the replacement is awaiting Senate confirmation hearings. And at the OCC, we have an acting comptroller who has not been yet confirmed by the Senate. At the very least, given the expected broad revisions, I hope the other agencies agree that a complete reproposal would be appropriate. So, Chairman, could you give me some indication of what the potential timeline around such a decision to repropose might look like?
It's pretty uncertain, but I'll give it a shot.
Please.
And I'll say again, that these discussions we've been having with the other two agencies have been very constructive, and we very much want that to continue. We've got pretty good agreement on the substance, and now it's about the process. So, you know, a baseline might be that we agree on a reproposal of some kind that gives the public a chance to see these changes and react to them and write comment letters. And so that could happen. You know, we would take us a while to write it up, and then we'd put it out for 60 days. I think that couldn't happen probably until part of the way through the fall. Then there would be, let's say, 60 days of comment, and we get the comments. We'd have to then evaluate the comments and think carefully about them. Having done that, we'd have to write up the final version, and that would take some time. So that probably puts you, my guess is it puts you well into next year. As I mentioned, these rules are rules that the banks are going to have to live with for a long time, and we need to get them right. It's not something we should be hurrying on. We need to take our time and get it right, and make sure that we hear the comments. This is a very big piece of regulation. A lot of things will need to be changed. There are a lot of good things in there. We want to come out with a good proposal, and that's what it'll take.
To shift gears on you, Chairman, the 2024 stress test focused on commercial real estate risk, which is an area we've all been paying close attention to here on this committee. Do you agree that the results showed the financial system to be strong?
Yes, I do.
The folks back home are always very concerned about inflation and the period we've gone through lately, not just the basic necessities that continue to explode, but the cost of doing business and all those other issues. The fact is the inflation's still running above the Fed's 2% target, and we've seen significant price increases in food and energy over recent years. As you and I have discussed before, I started out as a young farmer in 1977 in that inflationary period during the Carter years. Then when we went through Chairman Volker's rather, shall we say, dramatic tightening of monetary policy. And I still remember paying 17% to borrow cow feed money when I was a student in college. I was well collateralized, but that was a bargain in the fact that the cap was accessible. So I'm particularly sensitive, being a part of that generation, that if inflation isn't effectively dealt with, it can spiral out of control. Could you expand for a little bit more about your approach in dealing with inflation in a way that doesn't repeat the mistakes of the past? I just want to avoid the mistakes of the past.
So I think really one of the big lessons coming out of the high inflation of the 70s, which we both lived through, is that it really is on the central bank to be on the case and do the job and make sure that it is fully, well and truly done. And that really that is up to the central bank. And believe it or not, that wasn't fully accepted, or that wasn't necessarily the thinking. And also, the independence of central banks was much less respected back then. So all the more credit to Paul Volcker for having the courage to do it. So we now, that is an internalized lesson for people in
Pay
central
attention.
banking.
He keeps stressing that
You
independence
understand
of the
that.
bank.
We are committed to bringing inflation sustainably down to 2%.
One last question in my remaining seconds. You and the leadership of the Feds will be there the day before the election this fall, and you'll be there the day after the election. Still be the same people, carefully watching the Fed's responsibilities, correct?
This is my 4th presidential election at the Fed, and I can tell you, we come to work the next day and we do our jobs. It's just-
Gentleman's time has expired, and I'll
Thank you.
go to the gentleman
Go back.
from California, Mr. Sherman.
Coming out of COVID everyone said a soft landing was impossible and a recession was inevitable. I want to commend you and the administration. It looks like we've seen a soft landing. We've continued to have historically low unemployment rates and historically low unemployment rates for people of color. And in the last 18 months, we've seen a 4.7-point decline in the inflation rate as measured by the Consumer Price Index. Is that the greatest decline, or I realize you may not have done the calculations, but I did the calculations. It's the greatest decline that we've seen in an 18-month period this century. Do you have any reason to disagree with that?
I hope that's true, and I'm glad you said it, because it's certainly a lot. I can't validate the statement, though.
I'm sure you have a fine staff that will do the calculation, and hopefully we'll see the press release. When Secretary Yellen was here yesterday, I addressed an issue that both you and her should be concerned with. I've always opposed Operation Choke Point, where for political reasons, banks wouldn't provide or might not provide financial services. Florida and Tennessee have passed laws giving anybody who's denied a bank account or even a loan a way to claim that that was for political reasons, and it opens up the possibility that banks would be pressured by those laws to release their suspicious activity reports, which I understand are supposed to be private. And so I hope you'll work with the Secretary in making sure that the laws of Florida and Tennessee do not adversely affect our ability to deal with suspicious financial circumstances. You have a dual mandate. I think you have a third mandate that is implied, because the budget deficit poses a great risk to price stability and to keeping unemployment low. And you don't deal with spending, you don't deal with taxation. But in two ways, you dramatically affect the budget deficit. Federal government is the biggest borrower in the history of the world. Interest rates affect the forthcoming budget deficit. And at times, you've turned over to the federal government up to $100 billion in profit. And so I hope that you would consider whether your first two mandates imply that you at least have to look at how your policies affect the budget deficit. I hope that you will go with republication of Basel III and insist on that. I know you're dealing with two other regulators on that. A recent assessment by PricewaterhouseCoopers showed that the original proposal would lead to higher borrowing costs for small and medium-sized businesses. And in every way, Basel III seemed to be slanted toward telling the banks, go and put your money on Wall Street, where you just are going to have interest rate risk, and don't loan your money to local Main Street businesses, because there's credit risk there. And in fact, if you had a fair system, you would mark to market all bonds, not just those that are, quote, available for sale. I hope also that as you redo Basel III, you treat energy tax credits, green energy tax credits, the same way you currently deal with low-income housing tax credits, that you keep in mind the effect on the securities industry, particularly municipal bonds, that you don't unfairly to local business say that if it's a publicly traded company, it counts only 65%, and that you look at mortgage servicing rights as an asset, and that you fully account for the private mortgage insurance. I know you give some credit for that, but frankly, a 80% loan to value and a 90% loan to value that has private mortgage insurance pretty much expose the bank to the same risk. I'll ask you one question about the debit cards. You're planning to provide only, I believe, a 0.3 cents additional charge for dealing with fraud prevention. Fraud is just skyrocketed. Would the Fed consider increasing the fraud prevention adjustment before finalizing its proposal?
And that's part of the comments that we've received on the interchange rule, and it's something that's a concern that we're aware of, and we'll take that into consideration.
I yield back.
Gentleman yields back, and now the gentleman from the great state of Missouri, Congressman Lukemeyer, is now recognized for 5 minutes.
Thank you, Mr. Chairman. I certainly appreciate the thoughtful gentleman from California's remarks on some of the stuff, but I'm kind of curious how Chairman Powell, he indicated you got a third implied duty here to actually work with the budget. I really thought that only the Congress had the ability to impact the budget. We're the ones, not even the legislative, not the executive branch, not the judicial branch. The legislative branch is the one that handles the budget. Am I mistaken on that, Mr. Chairman?
I believe that is right.
I don't think you want our job on top of what you got. One of the things that's come across my desk in the last few weeks here is some of the legislatures this last year around the country have started to pass banking laws that infringe on federal banking laws. Have you seen this? Are you aware of it? Do you have thoughts on it? Can you tell me what your thoughts may be?
Honestly, I have not seen that, and
Okay.
it wouldn't necessarily come across my desk. It might come across Vice Chair Barr's desk more.
Okay, well, I was just concerned because, I mean, you handle lots of banking rules and regulations, and so we don't want to have the state usurp the duties and responsibilities and the legal ability to.
These are preemption issues?
Yes, preemption issues, what it's all about.
Yeah, that's a big deal for the OCC, as you know.
Yeah, so I was just curious if you'd run across any of that, had any
I
thoughts on
haven't.
it? Okay. One of the things, I just got done coming out of a committee hearing with small business a while ago, and there was a home builder individual there, a contractor, and he was talking about the cost of regulations. You know, basically $1,000 increase in costs about 100,000 homes across the country not being able to be purchased because they're no longer affordable. And so it brings up the point with regards to cost of regulations. You know, do you fall under the Administrative Procedures Act?
Yes.
So part of that act is to determine the cost of a regulation, correct? Or the cost of compliance?
I don't actually know the answer to that, but I
Okay,
know we
yeah.
follow carefully the
Okay.
APA.
But I mean, to me, that's a really important point from the standpoint of how you look at rules and regulations to ensure that the cost is not going to be more than the economic benefit of what you're doing. So, I mean, this has to be part of your analysis, I would think.
Certainly, we try to make our rules as efficient as possible and to get the job done.
One of the concerns we have is with, and I think the gentleman talked about the credit card situation here, Reg II. And with regards to the Chevron doctrine basically being rescinded, how is that going to affect your rulemaking with regards to some of the more recent ones like Reg II fees and stuff, the Basel rule? Are all those things going to be impacted by this at all?
I mean, it doesn't change our assignment under the Durbin Amendment to do the interchange rule. So we're always focused as an institution on compliance with the law. We're a very law-abiding group.
But does it narrow your ability to go beyond or reinterpret laws and rules and things like that? It seems to me that's what the rule.
That'll be a
what the
question
purpose
for
is.
the courts. I mean, the courts will be asking the same question, which is what was Congress's intent for that law? And that's the question we're asking. But what they're saying is courts will give less deference to agencies, I think.
Okay.
Again, these decisions were just passed down. I was actually out of the country last week while this is all happening. I've had no time to be briefed on any of that, so I'm kind of speculating here.
Okay. One last question. I asked this question yesterday of Secretary Yellen. What keeps you up at night? What is your biggest concern with regards to your responsibilities, to regards to the economy, regards to the banking system? What is your biggest concern?
So for a long time, it's been cyber, and the reason is, we know about credit crises and things like that, and financial crises, but we haven't really had something where there's a successful cyber attack on a major financial institution or financial market utility. That's always been my answer. I would actually say now the number one thing that just does keep me awake at night is the balance that I talked about before, which is we're at the critical time of inflation's coming down, the labor market is cooling, and we want to get it right for the benefit of the American people. We want to get inflation down to 2%, but we want to keep a strong labor market too, and trying to make decisions that give that the best chance to happen. That is the thing that I think about in the wee hours.
You know, we've talked about this before, too. You really got a tough job from the standpoint, you're trying to drive down demand administration by spending all this money, is trying to drive it up. It puts you in a really big box, doesn't it? Thank you, Mr. Chair. I yield back.
Gentleman yields back. Now we have the gentleman from the great state of Illinois, Congressman Foster, is now recognized for 5 minutes.
Thank you, Mr. Chairman and Chair Powell. You know, I guess when things are going well, it's as they currently are, it's all of our duties to look around the curve and see it, you know, the risks that keep you up at night. So I appreciate Representative Luetkemeier's question. Now, over the last few years, there have been increasing interest in synthetic risk transfers, SRTs, or credit-linked notes, which are often used by U.S. banks to shift risk away from the banking system and as a means of managing regulatory capital. So I've been concerned by recent reports that the buyers of some of these SRTs may be investing in them using bank-provided leverage, in which case the risk could just boomerang right back into the banking system. You know, frankly, when I read about this, it triggered my PTSD from the AIG situation with credit default swaps during the financial crisis. Now, I understand the Federal Reserve plays a role in approving SRTs, in fact, issued guidance to U.S. banks regarding their issuance last fall. Could you say a little bit about the ways that these investments can be a safe way for banks to offload risk, and in what ways they could become a dangerous source of contagion?
Sure. So there could be a breakdown in a couple places in the chain, as you're obviously aware. One is just that the risk isn't really well and fully transferred to the buyer. And that's just the first step is that risk going away off the balance sheet in an unconditional kind of a way, in a way that the bank understands? And that's a good thing if banks are able to do that. Then the question is it coming back through the back door with financing? And so we're well aware of that. You know, banks do tend to bring these things to us, and we look at them carefully. We understand some of the ways it can go wrong. And but at the end of the day, if it works to reduce the risk on a bank's balance sheet, you know, that's something we should be okay with.
Yeah, but you know, there's the well. If you could just say, what sort of insight and control does the Federal Reserve have into all the connections, particularly when the connection may go through businesses that you do not have direct, non-bank entities that you may not have direct oversight over?
My understanding is that this is a very active dialogue we're having with banks. They want to know how this is going to be treated. They don't want to do something that is going to come back on them or that we will deny the treatment on. So I think there's a pretty transparent set of exchanges around how these things work. We're very clear on what we think our requirements are. This is what I'm told, and you know, so we saw what went wrong the last time. I think no one wants to repeat that, including the banks. So,
well, if you conclude, and as you're actively studying it, that you need more visibility into certain areas of particularly non-bank things that may be part of the chain of contagion, please let us know, because you know it's our job to avoid the next crisis. I think it's my personal goal to die before we have another financial crisis, and then I'll be doing my job well. Now, I understand also the value of SRTs in the U.S. are relatively small, and the bulk of these are offshore. Is the growth of this practice internationally something you're watching closely, and is there anything that might provide a sign of early trouble in terms of international contagion that might creep back in?
So I haven't heard that flavor of it, but I'll check on that and let you know.
Do you remember with AIG, you know, the real problem with AIG falling into bankruptcy is that it would immediately put a bazillion of the European banks into violation of their capital requirements, which was major contagion.
Yeah.
Do you have a sense of the time scale for the liquidity proposal at this point?
I think, you know, the main thing is we have this very large, important project on Basel III, and I think we're pretty close to being able to move that out into the public view again. And I think once we've done that, we can move on to the other things that are there. And one of them is the liquidity proposals. And I don't want to put a specific time frame on it, but you know, we're certainly working toward that sometime later this year, I would think.
Later this year, we'll have the first view of that.
I would think so.
Okay. I understand it's still under negotiation between agencies, but can you say directionally the Basel III, the new amended proposal, is it just going to be in the direction of sort of weakening it, watering things down toward the current capital requirements? Or will there be areas where it's actually strengthening them?
Oh, no, there will be a capital requirement in it that is consistent with Basel III and a capital increase that's consistent with
My
Basel.
question is, if you look at what the original proposal was compared to, what you intend to put out, are you moving in the direction of more toward, the current situation? And if so, if you can just interpolate, it seems like if you have comments on the proposal you put out, you understand comments on the status quo, and you're somewhere between that, then maybe you don't need another set of comments because everything that can be said has been said.
It's a little more complicated than that, but that's essentially right. You have current levels of capital, you have the proposal, and you have, which is a lot of gold plating, and then you have where it's shaking out, and that's, but it's
So
more
I just was wondering why you need more comments.
There are many
if you're
different pieces.
between.
The answer is there are many, many different pieces of that.
Thank you, and I'm over time, and
Gentleman's time is up. Next, the gentlewoman from the great state of Indiana, Congresswoman Houchin, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you to the ranking member, and thank you, Chairman Powell, for coming to speak with us today. It's been a long day, so thank you for being here this entire time. One of the greatest strengths of our financial services industry is the diversity of our banking system. I know firsthand how important it is for us to maintain options and choice for Americans, whether it's somebody looking to open a savings account or take out a loan to start a small business. Increasingly, however, we have seen consolidation in the banking industry and increased difficulty for smaller financial institutions to survive. One of the reasons for this is an excessive regulatory burden that many of the smaller banks face. While this can come in the form of new proposals and adjustments to liquidity requirements or to things like Basel III Endgame, it can also be due to outdated technological capabilities at the agencies and inefficiencies in and within the examination process. Chairman Powell, could you just talk about what steps the Fed is taking to upgrade technology and procurement procedures and update training practices to ensure that the banks that you regulate don't face unnecessary burdens?
So to your point, the number of banks in the country has been coming down for 40 years. And there's consolidation going on for a whole range of reasons. And we're not trying to foster that. We're not trying to push that. And we're aware that, high fixed costs from regulation may be one of the reasons for that. So we do try to keep that in mind, particularly for the smaller institutions. On your question around, IT and specific things, I might take an opportunity to come back to you with somebody who's closer to the specific supervisory practices.
That would be
Fair
great.
question.
That'd be great. And just for reference, I was proud earlier this year to introduce a bill, the Fostering the Use of Technology to Uphold Regulatory Effectiveness in Supervision Act, or the Futures Act. It's an important bill that would require our federal bank regulators to conduct an assessment to ensure that the technology and training systems they are using will improve and reduce the burden especially on our smaller financial institutions. At the same time, the bill will strengthen the safety and soundness of our financial system by keeping our regulators up to date on the latest fintech innovations. So I was glad to see that the Futures Act move through the markup earlier this year. I certainly hope to see it come to a floor vote soon. Chairman Powell, in your comments yesterday in the Senate, you said Basel III will need a, quote, meaningful revamp. Before we proceed toward finalization of that rule, I was glad to hear you say that. Considering 97% of public comments on Basel III were negative, with 86% of that negative feedback coming from outside the banking sector. Many of my colleagues here today have highlighted their own concerns with Basel III. Given the pressure that Americans are already facing with inflation and increased interest rates and housing market stalls, I would urge that you take a good long look at the cumulative effect of this rule in context with the broader economy, our small and mid-sized banks, not just the larger financial institutions. Will a meaningful revamp include consideration of the hardships that overregulations cause for smaller financial institutions like those that are essential to rural communities like mine in southern Indiana?
I think it will, yes.
And are you concerned about the consolidation that we are seeing in the banking sector? I know you said it's been going on for 40 years. Does consolidation in the banking sector concern you? And are you concerned that the broader effect of cumulative rules is potentially leading to a further consolidation in the banking sector?
Again, we don't want to be part of the reason for that consolidation. It seems to be happening, though, organically. We allowed interstate banking, for example. Also, I think for a long time, the learning was there weren't a lot of economies of scale in banking. I think with all the technology costs, that old learning is now not really true. And so I do think, in fact, I think a lot of the sort of smaller regionals do feel that they need to grow to be able to compete with the larger regionals. And also, the very largest banks are also present, as you well know, in many, many communities where they weren't 30 years ago. So I think people are seeing a need for scale from a business standpoint. And we don't want to push consolidation. I think we also don't want to stand in the way of it if that's what's necessary for banks to compete with the largest banks.
I appreciate that. Thank you, Chairman Powell, again for your testimony. Our financial system is really the envy of the world. We need to make sure that small and growing institutions have the tools they need to innovate without any undue burden. I appreciate your emphasis on that in the meaningful revamp. Thank you, Mr. Chairman, and I yield back.
Next, the gentleman who set a record for a mile run this morning in Washington, D.C. From Illinois, Mr. Caston is now recognized for 5 minutes.
Thank you, Mr. Chairman. You looked much better and well coiffed when I saw you this morning than I was. Nice to see you again, Chair Powell. Just briefly on the Basel III reforms, you and I have talked about the tax equity provisions and the fact that clean energy tax equity got a 4 times risk weighting relative to other tax equity in the last version. If there is a reproposal, can you give us any visibility on whether clean energy tax equity will go back to the 100% risk weighting that it's historically had?
So I'm not going to give any specifics out today because, the usual arrangement is nothing's agreed till everything's agreed. So I don't want to get into what the specifics are. I'm hopeful that the 3 agencies can come out, pretty soon with the whole package.
Okay, well, the sooner even something temporary, because there are a lot of banks that want to participate that are I think more cautious than they need to be right now. Appreciate that. In 2021, I think you were a part of the FSOC report on climate-related financial risk that for the first time identified climate change as an emerging threat to U.S. financial stability. Do you still agree with that conclusion?
The conclusion being that what again?
That climate change was an emerging threat to U.S. financial stability.
Yeah.
Okay. I raise that because I've been troubled, as you know from some of the letters we've written, by this April Bloomberg report that said, number one, that Fed officials were pressuring the Basel Committee to make disclosures of banks' transition plans optional, and that succeeded. Number two, that the Fed, OCC, and FDIC were pushing to limit implementation of the Basel Committee's climate risk management principles to remove financed emissions. And number three, that the U.S., unlike other countries, did not propose that any of its banks be subject to an analysis of how they incorporated climate in their credit risk assessments. Have any representatives from your agency attempted to weaken the Basel Committee's work on climate risk, including by expressing concern about the Basel Committee overstepping its mandate with respect to its climate work?
Well, I guess I would say it this way. The Fed does not have a mandate of fostering an energy transition or dealing with climate change. Some of the Northern European banks feel that they do. They actually have that. It's in their mandate, either explicitly or implicitly, but we don't.
But if we agree that climate change is an emerging threat to the stability of the banking system, are you saying you're not acting on it because you don't have the authority, or you're not acting on it because you disagree with what you said in 2021?
When you say it's and I agree, there's an emerging threat to financial stability, that's over time. I think looking to the banking agencies to lead the fight on climate change is a big mistake. I think it's a job for elected people. We don't have that mandate in the United States. We can do a very limited thing, which is make sure that the institutions we supervise are aware of and can manage those risks. We are not going to be the ones who are forcing them to adopt plans to transition and that kind of thing. That's just not going to happen through the banking agencies without a law change.
So then if it is the view of the rest of the world that climate change is a financial risk and we're going to regulate our banks, is it the view of the Fed that the U.S. G-SIBs should not be required to report?
Again, we're not going to be climate policymakers at the Fed. We are not going to do that. We don't have that mandate a key to our independence is that we stick to the job you've given us. And the idea that we should discover climate and say, okay, we're going to lead the fight on climate, it just, we do, if we're going to do things like that, we should be part of the Treasury Department.
Well, so to be clear, no one's under the illusions that you're the EPA. But, you know, I spoke with Janet Yellen about this yesterday. We have multiple states where the insurance industry is collapsing. Something like, as you know well, something like a third to 40% of US wealth is tied up in real estate. And, okay, US homeowners are not GSIBs, but in the 2008 financial crisis, we had risk that moved out of the GSIBs onto other entities' balance sheets, and we said, well, we're not responsible because it's an insurance company. Well, we've fixed that. You do now have a mandate to, if there's systemic risk in the system. And so the question is, if we know that risk is moving through the system, is the FSOC monitoring that risk, or is the FSOC's view that if I'm not allowed to look at it, I'm not going to look at it, and it's somebody else's problem? Because somebody else is the person sitting here, right?
I mean,
we're going to be accountable if that risk comes when those chickens come home to roost.
Well, the banks know their risks pretty well, and you see the banks and the insurance companies pulling back from lending in coastal areas and things like that.
No, I agree, but where are they offloading that risk to? If they're we've seen them putting it onto Fannie and Freddie. We've seen Fannie and Freddie try to put it onto the reinsurance industry. The risk doesn't go away.
Time is up.
We don't regulate them.
Gentleman's time is up.
Yield back.
Next, the gentlewoman from the great state of Missouri, Congressman Wagner, is now recognized for 5 minutes.
I thank you, Mr. Chairman, and in keeping with baseball analogies here, I think I'm batting cleanup. Chairman Powell, welcome in this afternoon to you. Chair Powell, in your testimony, you stated that, and I quote, longer-term inflation expectations appear to remain well anchored. Could you please expand on that for us?
Sure. So in our thinking, and the thinking of economists and central bankers, what the public expects about inflation is really important, because if you expect there to be low inflation, then it probably will be low, because you're gonna make sure that's true in your daily decisions. So we measure them. We survey individuals and businesses and market participants, and then we look at market-based. You can also derive market estimates of what inflation will be through various instruments in the markets, and all of those suggest that people expect inflation to be right around 2% over the longer term, and that's been very stable right through this episode.
When you say longer term, sir, how many years would you be estimating? 1 year, 3 year, 5 year? Is there any?
So we look at short and medium term inflation expectations too, and they tend to be more volatile because when inflation's high, people think that'll last a few years. But one standard thing is to look at 5 year, which is between year 5 and year 10. That's a standard way to look, or longer term than that. If you just ask people in surveys over the longer term, you maybe don't specify, but they all give you the same answer, which is people kind of have faith that inflation will go back down to its 2% level.
There has been some reporting lately on shrinkflation. And for our viewers, I'll say this is when you pay the same price for something as yesterday, but get less of it than before, kind of like my bag of potato chips. Some have sought to direct attention away from the pain of runaway inflation that we've experienced, and instead blame producers who themselves face rising costs pressures. Yet, I haven't seen any mention of shrinkflation as an inflation cause in any recent monetary policy report. Moreover, a Bureau of Labor Statistics article last year looked at shrinkflation and concluded that, and I quote again, it has a minuscule impact on overall inflation. Chair Powell, from the Fed's perspective and analysis, has shrinkflation been a significant casual or amplifying factor in the runaway inflation of the past several years that has imposed maybe greater pain on American workers and households?
I'd have to say no. I mean, I would say it this way, packaging in the U.S. on food products and that kind of thing, it's going to disclose the contents of the thing, and the price will be what it is, and consumers can make their choice to buy it or not. But But we don't think that's a major driver of inflation, no.
I think from a producer standpoint, it probably is. If the cost of the item is exponentially higher.
It may reflect costs on the part of the producer, it probably does, but that doesn't mean it's a cause of inflation as such.
Okay, thank you. So, switching topics, the Federal Reserve has produced volumes of research over the last decade, highlighting the negative consequences of the debit interchange fee cap. Some of the economists who produced that research have even worked on this proposed rule, the Reg II. Chair Powell, was the previous Federal Reserve research demonstrating Regulation II's detrimental impacts to low-cost checking accounts flawed, or did it have incorrect conclusions? And if not, then why would the Fed propose this rulemaking when all of their research demonstrated detrimental impacts? Please.
I am not entirely sure what research you're referring to. I'll be happy to follow up with you on that.
Yeah, I hope you are, because I know we're having this discussion about the interchange fee caps and Reg II, and I'm concerned about going forward on that when much of the research that we have seen from the Fed has been pretty steady over the last number of years, says it has quite detrimental impacts. So please, to low-cost checking accounts. So if you wouldn't mind, I would love to get some answers on that. And also, why hasn't the Fed taken into action the higher fraud costs that debit card issuers will incur as a result of the new dual routing mandate for card not present transactions? I'm over my time. If you could also answer in writing, I would be ever so grateful. I yield back, sir.
Bailey yields back, and I would like to thank Chairman Powell for his testimony today. I know you got to get out of here, and without objection, all members will have 5 legislative days to submit additional written questions for the witness to the chair. Questions will be forwarded to the witnesses for his response, and I ask you, Chairman Powell, to please respond no later than August 30th, 2024. With that in mind, this hearing is adjourned.
So yeah, that was Fed Chair Jerome Powell getting scrutinized, and I think the biggest takeaway, besides just the emphasis on the Fed wanting inflation under 2%, I think something that I really took away from it was just the production of it all. I remember watching these same meetings when Alan Greenspan was the Fed chairman, and he was so deadpan. There was a lot more straight to the matter type of question and answering. Not much extracurricular dialogue, as you can see. And this was like not production. This wasn't a production necessarily for clickbait or anything. It's just to I just see the difference in the cultural shift, the collective consciousness of what is acceptable as far as decorum, as far as production, as far as how things are conducted. And You know, there's a different. You could argue that there's a softening, an easing, more relaxing of behaviors and how people conduct themselves. Like there was moments of real levity in this meeting. There was moments of personal, just a level of production that allowed for, I think, I think that while it won't be appealing to the public at large, or a big viewership, there was a subtle acknowledgement of the public tuning in to see what is going on, what this meeting is all about. Especially with being election, people are savvy. Certain people are looking to gather information from different sources about the economy, about the economic outlook, and then the overall outlook of just the country. And so, there are people who will be tuning into Jerome Powell many times for the first time, and the added production and acknowledgement to the public, to the regular public, so to speak, the public who wouldn't normally be attuned to this type of content. I think it's just is indicative of the social mediaization of everything. But anyway, I don't know if that makes sense what I said, but anyway. I thought it was interesting the continued emphasis on independent agency. Jerome Powell emphasized more than a few times the independent agency, and maybe I can rewind it back and find it when one of the committee members commented that the Fed truly values their independent agency, and that's something that a lot of people don't realize, is that the Fed, the Federal Reserve Bank, is an independent agency. It's not a part of the government. It's an independent agency, and it's really just a huge, big business. And business is meant to make a profit. So there's always the question of their motives. Okay, and just leave it at that. So that is the nature of the scrutiny, the questions, because in theory, it's supposed to be a bit of a collaboration, a partnership with the Fed, the business, and the government. The government doing business with an independent agency, a powerful independent agency that has incredible power and access and influence and everything, but an independent agency nonetheless. That can, with the name Federal Reserve, it can make people think it's part of the government, and people think the government is for the people, and that's not the case. Not always the case. And this is something that always has to be considered whenever you're because really they're a business. Keeping in mind that they are a business. They are a business who thrives on information, and that was another takeaway: is the data and the information. And there was a few subtle points that alluded to the importance and the value of the data and the information and the sources. And there was one part where one of the committee members made a comment to the data, alluding to the data, and Chairman Powell corrected him. He mentioned that the committee members' information and data was coming from the CPI report. The CPI report is the Consumer Purchase Report indicator, and the information is sourced from consumers, and it leaves out a number of different factors that allow evaluation and assessment of the market. And so it's not the report that the Fed values, the Fed really uses. They go off the PCE report, which he mentioned to the gentleman. So the PCE report better reflects the changes in household consumption patterns, and it better reflects changes in the cost of living and price trends in the economy. Okay, so it's just a better assessment of the data. And the source comes from businesses. So, of course, if you're sourcing data from consumers, regular individuals, who is really organized with their data, who they are not bound to any type of scrutiny, they're not bound to any type of code of ethics as far as the information that they're sharing. This is just basically surveys of regular individuals, as opposed to businesses. Businesses, they are in the business of keeping good records, so their data is a lot more reliable. This is what is the PCE. The PCE is based on data from businesses, and it includes a number of additional factors that really pinpoints reflects the changes in household consumption patterns, and reflects changes in the cost of living and price trends in the economy. So I thought that was interesting, because I've been very high on just data, period. I mean, just really sitting and thinking about the business of data and how that relates to opportunities. I think the business that can organize data, the big businesses from going forward, great opportunities for entrepreneurs is always going to be involved with data, because that can, depending on your business model, the vertical integration could be marketing and a host of other things, but data is the foundation of business. So any businesses, any entrepreneurs, they can harness the power of data in an efficient way, in a way that's valuable, in a way that makes sense to a particular market, you're going to win. And to that same token, data and then information. Information comes down to what? Research. So research companies of any kind, lead generation, we'll see that depending on your business model. Because when you get into lead generation, then that takes on a whole life of its own. But thinking of businesses that I don't want to say are low barrier to entry, but I'm thinking of how you can maximize low barrier opportunities, data research, information research, just research is something that I've thought about and really want to explore, and really would, given the opportunity, given the right opportunity, would like to invest in, would like to try putting together the right team, the right model for, I haven't really sat down and explored it, but research, and then data will be the next form of integration. You know what I mean? I'm just talking, but yeah, data and the PCE is what the Fed values, and then they source their data from businesses, and so you could say that that information is a lot more reliable. And the question is that the underlying question that kept surfacing is about inflation and about recession. Are we in a the question wasn't asked, but I'm going to go ahead and ask it because it's really the elephant in the room is making a forecast about recession. And at this point, knowing history, the indications of the implications of a recession really don't hit until months later. And then in hindsight, you can point to a point in time where you could definitively say that we were in a recession and we didn't even know it. And that could possibly be right now. We could very well be in the throes of a recession right now, not officially. The recession really didn't, by label, didn't really come up too much. The word recession didn't come up too much, but it's always something that's looming and lingering as far as the economic outlook. And I just want to pose the question: if do you believe we are already in a recession right now? Because history shows that you get to a certain point when you're already full swing in a recession, you can look back and pinpoint times when, okay, we didn't realize it at this time. It didn't come up as a subject, but we were already in a recession right now. We just didn't see it. Sometimes you just can't see the forest for the trees, right? And I don't know. I don't even want to make an assessment. When I look at, so right now, you can see I'm in this trade with, where I'm always watching Goldman Sachs. Goldman Sachs is a great indicator of, it's a good market indicator. And then SPY is, so we're making new highs in the market. But then, I don't know. Making new highs in the market, but that could be just like a last-ditch effort before stuff precipitously falls. You can see that. Could be propped up. The economy could be propped up for a long time, especially the market could be propped up by a number of factors, especially with it being an election season. So that's why it's never, just as a rule of thumb or principle, is it's never very wise to try to time the market. Time in the market is better than timing the market. And you play your positions as prudently as possible, and preserve as much capital as possible. But as a trader, as an investor, you know there's been times, if you've been in any type of market time frame, you know that there's been times when it looked like there may have been a downturn, and then you sat on the sidelines and slowly watched a nice bull run, and you missed out. We've all been there. And that could very well be the case right now. So, yeah, it's all about playing safe positions. I'm pretty bullish right now on the market, at least until through the election. And Goldman Sachs is my main money maker, what I'm looking at. And I'm looking at Goldman Sachs to start moving towards 500. So I'm playing some 500 calls, or at least have them on my watch list. And I don't know, Chairman Powell, he seems pretty. He seems pretty optimistic. He don't look like he's ready to jump off the deep end on anything. But I don't know. We don't know. That's good. Well, I mean, he's gonna be straight regardless, you know. So this and this is a lot of this is real high level, even for me, I mean, for me, it's high level, but there's a medium for the little man to glean some information and then just get some information to be able to put their chips strategically in places and pick up some crumbs from the big movers, right? That's all we really want to do. We really can't move the market, so I'm looking at Goldman Sachs and see what they're doing, and I'm riding the wave with them because they are at the pulse of the market. Goldman Sachs, they are the biggest underwriters of IPOs and developments and all the such. They are, a huge investor. So everything flows in and out of banks. That's just a basic principle of the market. So I think it's just prudent to at least keep an eye on the banks to see what they're doing, what's going on. And Goldman Sachs has been making a nice little run. They got earnings coming up, so there's always that's always a part of the your analysis, understanding what the earnings play looks like, how that's going to play out. Earnings can make or break you in your account. Earnings can set the stage for be a catalyst for some nice returns, some nice runs, some nice returns. But I won't get into any market strategy right now. I really want to take a break and come back and break down some more overall market talk and see where the opportunities lie. He mentioned real estate. He mentioned the collapse of insurance agencies, and so I want to dive deep more in that and explore that. But I'm gonna go ahead and play some commercials and some interludes right now.